It's August 16th, 2007, and our trader is looking to trade the E-mini NASDAQ 100. He's got a 2-minute chart up here, and he sees that the price action is in that region, which I call the dead man zone, the DMZ, where price action is near the PVP, and the PVP sandwich between the VWAP here and the first standard deviation here. So he's going to wait and see what kind of trade to take. You notice that the skew is very small. That's this difference here compared to the size of the standard deviation from here to here. So we've got a small skew. It's kind of difficult to decide what kind of trade to take. But if he sees a breakout down here at the first standard deviation, he'll take it and hope the breakout succeeds and takes him down to the second standard deviation, where he'll have to make another decision about what to do. Market moves up here. He'll wait till it crosses the VWAP and then retraces, and hopefully use the Shapiro effect to get a long trade up to the first standard deviation here. So let's watch and see what trader would do. If we get a breakout down here, he'll take an entry at let's say just below the first standard deviation at 851, and then see if he can follow it down to, oh, let's say 845. That would be a nice trade. But in any case, he's just sitting here and waiting. You can see with this small skew that the volume distribution function is reasonably symmetric. We got a little peak over here, we've got another peak over here, and then we have the major peak in here where the peak volume price is located. So anyway, we'll just sit and wait. Don't do anything at this point. You see that the market is sort of waffling around in this region, not doing much of anything, trying to make up its mind about which way to take itself. And we'll just sit with it as well and let it decide first before we make any decisions. So 851, we're looking for a trade, an entry. If we break out this way, we're not going to use the Shapiro effect here. Usually breakouts, when they go, they just zip right along. Not much time to even think about doing much of anything. If 851 gets hit, we're in. 851, 851, there we are. 851, 850, 75. We're in the trade for short. Let's see if we can follow this thing down to our profit target, which will be 845 right here. Okay, the breakout has occurred. Let's hope it's not a false breakout. Many times they are false breakouts, but we'll see what happens on this one. Considering we already have a small skew, it's very possible for the VWAP to start sliding down below the peak volume price at this point. When we get to our profit target, we'll then have to make a second decision after exit about what to do. We still have a very small skew. There's a possibility for a counter trend trade going back up to the first standard deviation because of this small skew. Remember, in symmetric markets, price action tends to oscillate back and forth across the VWAP. So that's a real possibility here. But right now we're playing the breakout trade down to 845. if we get to that point. Market's still going down, pretty small down. There we go. 845, 845 and a quarter, 50, quarter. One more tick. Jumpy here. 846, 45, 75, 50, 50, 25. There we go. We're filled. Okay. So there's the profit on that breakout. Now we're going to wait again. We won't do anything until the market drops below the second standard deviation, and instead of trying to play the breakout further down here, we're going to try and use the Shapiro effect. And if you remember, the Shapiro effect says if a trade is good now, it's going to be good 5 minutes later. In our case, what that means is if it's good on the entry bar, it should be good on the next bar as well, and we should look for confirmation of that trade in the direction that we're headed. So if we're looking for a counter trend trade, we should be looking for a bar that exceeds the high of the last bar that touches the standard deviation. So here we are, market's still dropping. It's conceivable that we could have a further breakout down to the third standard deviation, in which case we would look for an up bar that comes back to the second standard deviation and then breaks, next bar breaks below that. So here we have another down bar, and we have not taken any trade yet. It looks like we're going to have a breakdown here further. If we don't get into the trade, tough luck. But we're going to wait. We're going to wait and see what the Shapiro effect might give us, if there's anything to be had on this. Doesn't look like we can play the breakout to the downside with a reversal. So possibly there might be a counter trend trade that we could take to the upside here. Remember, we're looking for a counter trend trade, we're looking for a bar that, an up bar that will exceed this down bar. In that case, we want a bar that's going to exceed 1844.50. And if we don't get that bar, then it means that the market's going to continue to head down even further. So we'll just sit here and wait. Again, we're applying the Shapiro effect. We clearly missed the breakout trade at this point at the second standard deviation to lower prices, but you know, that's the breaks. We'll still wait and see if there's a counter trend trade developing here. Remember, this is a symmetric distribution right now. VWAP very close to the peak volume price. So it's possible for this market to come right back up and come back to the first standard deviation or even back to the VWAP itself. Okay, here's the market coming back up. 844. 844 and a quarter. There we go. 844.50. We're going to take that trade to the long side. Our expectation here is for the price action to bring this thing right back to the first standard deviation, where we'll exit the trade and then make another decision about what to do. So we've got a reversal on our hands here, a counter trend. It's counter trend because the VWAP is up here and the price action is down here. So when you're below the VWAP, you always have a downtrend, and we're trading long with our entry at 844.50, and we're looking for an exit around 849.50, about here, right here, 849.50. Hopefully the market will head back up to this point where we'll exit. It'll be a nice trade of a 5-pointer. And that'll be our counter trend trade. We'll exit there and then make another decision. We will use the Shapiro effect again if we can to see whether or not a possible trade entry in either direction can materialize, either back up to the VWAP, or considering that the VWAP is sloping down and about to cross over the peak volume price, it may continue on down, and to do that, prices have to continue to drop. But we're waiting here for this counter trend trade to complete, hopefully in the direction that we took the long, up to the first standard deviation. We're at 846.75. Market's still moving up. It should be a good trade to the upside. If it is not a good trade to the upside, we'll of course have our stop loss at break even down here. We'll simply get out of the trade at break even, say +1 tick. So there we are, 849.50, 849.75. Okay, we're out of that trade. So we've got two successful trades in a row. A short for the breakout and then a long for the counter trend trade. Now we have decision time again. If this market is to continue back up, we'd be looking for a down bar, which is then going to be followed by an up bar that exceeds its high. If we're going to have a trade that is short, then we're looking for a down bar that exceeds this last up bar's low. So here would be our entry for a short, and we're waiting for this down bar to complete, in which case we would wait for the next bar and take an entry at 850.50 on the upside. Our bias at this point, of course, is to the upside because of the fact that the distribution is symmetric. But we'll wait and see what happens here. You notice how the market pauses or slows down at these standard deviations. These places are called hold-up prices. Hold-up prices are places where the market slows down, pauses, and possibly reverses. Okay, we have this down bar developing. We'll see how that completes. Okay, we have a completed down bar. It didn't make it all the way down to 844. 845. Our entry would be at 844.75. So let's see what the next bar is. If the next bar, that's a down bar, next bar exceeds the high here, then we'll take a long trade. That's using the Shapiro effect. Shapiro effect says we had an up bar and then we had a down bar which touched the first standard deviation on the reversal. Now we're waiting for the next up bar to exceed that high, and we would hopefully follow that up to the VWAP. Close but no cigar on that uptick. Looks like the high of that down bar is not to be exceeded. Market looks like it's going to head back down again. So we will look for a trade down here at 844.75. That would be using the Shapiro effect on this up bar. Again, the Shapiro effect says we touch the first standard deviation on the upswing, expecting a short. We would normally take a short at that point, but the Shapiro effect says wait. Wait until you get confirmation. Confirmation would be below the low of this up bar. Okay, if we hit 844.75, we'll pull the trigger short and take that trade down to the second standard deviation. Again, you see we have a symmetric distribution, but the VWAP is continuing to drop at this point. The market continues down, the VWAP will eventually drop below the peak volume price and continue on down. And then we would positively be looking for only shorts after that. Okay, 844.75. $44.75. Did we get a fill to the downside? $45.25, 45. 45.70, 44.75 again. Keep banging up against us. 44.75. There we are. We're filled. Okay. Exit point 42. 42.50. 42.50. That would be a 2 1/4 pointer on this down move. You see the VWAP now crossing over the peak volume price. Price action is heading down. We're looking for 42.50 exit, 43. $43.75, 50. Come on down. $43.50. $43.25. $43.25. Jumping around here. $43, $44. Heading back up. We're going to stay in this trade. Now here's an example where there may be a possibility of a scale-in if we get back up to the first standard deviation. Rather than simply exiting this trade, we would scale in at this point again to the downside. But depending on what the price action looks like, we could decide exactly how far we'd want to take the trade. So at the moment we're still in it. It's coming back down again. 43.25. 43. Playing games with me. 42.25. 43. 42.75. 50. Bill? Here we are. 42.25 was hit. Okay. So that's how these are played out. At each of these standard deviations, you make a decision. And when the VWAP is near the peak volume price, that decision could actually be in either direction, with your bias to the upside in this case. But you need to be prepared to take trades in either direction, depending on what the price action looks like. You can always use the Shapiro effect to make a decision as to which way you want to take the trade. Okay, good trading to you.